Hi, everyone. Jeff Clark back here at goldsilver.com with Mike Maloney for another quick video. Mike, how are you doing?
I'm doing great, Jeff. How are you doing?
Good. Well, in the last video, I said I wanted to look at how long it would take the S&P to recover from some of the major crashes that it's had. And the reason I wanted to do that is because you've said that the next crash could be the mother of all crashes. And if that's the case, how long should a stock investor expect their stock holdings to be down and before they get back to where they were? So this data that I've dug up here shows how long it took each of the four major crashes in the S&P 500 since the year 1900 to get back to the same level of purchasing power as it was before the crash. In other words, it's not just getting back to the nominal price, but it's getting back to the same level of purchasing power as you had at the peak. And as you can see here...
Yeah, inflation adjusted, you're saying. Yeah.
Inflation adjusted, exactly. Thank you. So you can see here in 1906, the first one there, that's when the bull market peaked in the S&P back then, and the recovery period was 22 years. So from 1906, it took 22 years for you to get back, not just to even in the nominal price, but get back to the same level of purchasing powers you had before the crash. It took that long. And then the next one there you see is 1929. That's the Great Depression. It took 27 years to get back to, again, not the nominal price, but the same level of purchasing power as you had back in 1929. It took 27 years to recover. Then we have the one in 1968. You can see there it took 2 full decades to get back to the same level. And then the one we had in 2000 took 15 years. Now, some people will look at that one and say, hey, wait a minute, we got back to even in 2007, then back in 2015. But again, I'm inflation adjusting this to see how long it takes to get back to your same level of purchasing power. So if we do have another huge crash like you're predicting, it could take not years, but literally decades to get back to even is a way to put it.
Yeah,
and Mike, I think yeah, go ahead.
Something I'd like to point out is the one where it peaked in 1906. If you add the 22 years to that, that puts you at 1928 to get back to even. And then the following year, it crashed again.
That's exactly right.
Years. So you only had your head above water for a few months, and then it crashed. And these crashes, people don't inflation adjust things in their heads, and they look at markets and they think that something is just doing really, really well. And I'd like to steer this toward another chart for a second. And that chart is the S&P 500 against gold for this entire century. And this is not inflation adjusted. So you'll see that the red line here at the bottom, the stock market crashed and went down and bottomed and then recovered, and it poked its head back up above break even in 2007. But it didn't really, if you inflation adjust it. It was significantly down in 2007 and didn't recover. It wasn't until 2015 here before you got to break even. And right now, inflation adjusted, you're actually about 25% up. This is 68%, I believe, nominally from the year 2000. So this entire century. And then, the general financial media, they hate gold, but gold, for this century, it's been one of the best performing assets there is. Yeah, we've been in this brutal cyclical bear market inside of this secular bull market, but I'm pretty sure that this is nearing an end. And the next time we see the S&P going down again, I think you're going to see gold enter its third phase, and that's where things will really take off.
And that implies that stocks, common stocks, like in the S&P and Dow, may take years, if not decades, to fully recover to get you back to break even in terms of purchasing power. And that's why it's important to inflation adjust, because you're going to use these proceeds to actually buy things, whether it be groceries or a vacation home. So it's important to look at it that way, and that's another reason
Groceries
why
are a vacation home, but for a lot of people, it's their retirement. This is, one of the things in life that is a challenge is figuring out how to be able to die comfortably.
right.
And you work for a very long time so that when you get too old or too sick to work, you don't have to. That's one of the reasons for investing and for saving. And if somebody rides out one of these crashes, it is just devastating for their ability to be able to die comfortably.
Very difficult to do so, and that's one reason why I think all of us are buying gold and silver. I just bought a little more silver last week, in fact, so I'm very happy that I continue to accumulate. So, Mike, thanks for your time, and thanks everyone again for joining us. Keep up with us at goldsilver.com. Don't forget we have a price match guarantee, fast shipping, and a special insiders program. Thanks, and we'll see you next time.
Thanks a lot, Jeff.